U.S. household wealth declined for the first time in 2 years in the first quarter of 2022 per the Federal Reserve. Although if you have been in equity markets in 2022, you likely already know this, and this comes as no surprise. Take a look around, talk to people. Nobody is very enthusiastic about the economy right now for good measure. Interest rates will continue to go up. Inflation will remain stubbornly high for a very long amount of time, and we are already very likely in a recession. Shout out Joe Biden. I told you so there, partner. Shout out to America and shout out to the veterans. You do have a point there. Right. Happy 4th of July. Shout out to the vets and shout out to all of you guys watching this video. Go ahead, hit the like button and subscribe to the channel for more videos just like this one. Unfortunately, no, we are not a political channel. I know some people would like that, but we have absolutely zero political affiliation. I saw the opportunity and wanted to throw that in here. Thought that would be quite cool considering it is the 4th of July. So shout out to all the vets. Shout out to anyone that has served this country. And if you are an American in general, if you are not, we still love you. Thank you for tuning in. Hit that like button and subscribe to the channel. Now, first things first, let's start off with a little bit of bad news, then we'll get into some good news. So another crypto lender, Vold, pauses withdrawals as market crash takes its toll. The key points: crypto lender Vold on Monday paused all withdrawals, trading, and deposits on its platform and is exploring potential restructuring options, the company said. Vold said it is facing financial challenges due to market volatility conditions, which has led to customers withdrawing more than 197.7 million from the platform since June 12th. And it says Vold is yet another victim in this whole crypto winter situation. Now, the stock market for the better part of the last couple of weeks has been able to kind of brush off some of the things going on in crypto. You would imagine BlockFi, you would imagine Voyager Digital, now this other crypto lender, ceasing operations, essentially going bankrupt, to have a bigger effect on the markets, but it's actually not. So I think that is something that will have a bigger impact, but is not really at the forefront of investors' attention. The biggest thing that markets care about right now is a recession, and the Fed is indeed pushing us into a recession. If you guys have not seen this, the Atlanta Federal Reserve now expects Q2 GDP to come in at negative 2.1%. Just last week, we were expecting a positive 0.3% Q2 GDP report. Given those data points that came out on Thursday and Friday, this has really flip-flopped, and I doubt the Atlanta Fed GDP Now tracker is going to be that far off. We're probably going to get a really bad print, and we will probably be confirmed in a technical recession coming on July 28th. We also have the Fed that is expected to raise rates by about 75 basis points coming July 27th, and we do have Apple, Google, Amazon, Tesla, Nvidia, all these large companies that control the stock market by an overall weighting that will be reporting during this time period. So I do think that's when you could get this flush out event that I've been talking about. You could see a lot of margin calls, more bankruptcies, and then we could start to make our way up from the bottom at that point. But here between tomorrow and the end of July, we still have like 2.5-3 weeks until we get down to some of those big fear catalysts. But between now and then, economic data that either signals that we are going into a recession or potentially not going into recession, that's going to be the most important thing. I know a lot of people are still talking about inflation, but when you're faced with a recession, what always has happened? The price of oil plummets through the floor. The price of pretty much everything starts to come down, and inflation would no longer be a major concern. The concern would be a recession, and that is why you have seen bond yields going up in a pretty substantial way over the last couple of months, and they have since started to fall in a very dramatic fashion over the last couple of weeks. As investors fear a recession more and more, they will go out and start buying the 10-year treasuries, the whole yield curve, for a matter of fact, because hey, if you can get a guaranteed almost 3% yield, if you start to see 2% inflation and very shaky and wobbly growth, well, 3% guaranteed doesn't sound all too bad in that scenario. If people were not concerned about a recession, they were concerned about inflation, like we just were when bond rates went from 2.75% all the way up to 3.5% only in the matter of about 2 weeks. People were more fearful about inflation because if you thought inflation was going to be 5% for the next 10 years, well, why would you take a 3% bond yield or a 3.5% bond yield? You wouldn't do that because you'd massively lose to inflation even over the long run. So watch the bond yields. If bond yields tick up, markets are more worried about inflation. If bond yields continue to come down, they are more worried about a recession, and that could be a very bullish thing in the short term. If bond yields do come down, the cost of credit, the cost of getting a mortgage, the cost of getting a car, and everything else in between will become cheaper as these bond yields do continue to drop. But then ultimately, once we go into recession, there's going to be more fear than potential excitement over these lower bond yields, and that's where you could get a big move to the downside. But what we have for this upcoming week as far as economic data that could move the markets, well, you got a lot of it. So on Tuesday, you don't have all too much. You do have some Bank of England speakers, shouldn't be too important, but at 10 in the morning, you do have factory orders month over month for May. That will be important because that is showing manufacturing. That is a big segment of the GDP report, and that will give us an indication of, hey, you know, how are factories doing? Is that going to be something that helps lead us into recession or not? Now, on Wednesday, that's where things really start to heat up. You have Fed Williams that speaks at 9 a.m. And then at 10 a.m., you have ISM non-manufacturing PMI for June. 10 a.m. as well, you have JOLTS job openings for May. And then the holy grail of catalyst, which 2 p.m. on Wednesday will be the FOMC minutes. That is the transcript of the last Fed meeting, and we will know with a little bit more clarity why the Fed raised rates 75 basis points. It will give us a little bit more clarity as to what to expect coming on July 27th. So that's going to be a very big catalyst. You're going to get a lot of headlines from that coming 2 p.m. on Wednesday. Now on Thursday, another big day, you have ADP employment change for June. That comes out at 8:15 in the morning. 8:30 a.m. you have balance of trade, and that is very important for GDP. That is the trade deficit. We are expecting a negative $87.1 billion trade deficit. If that comes in much worse, well, hey, that could obviously be a very bad thing. We have exports for May, imports for May, all of that coming out at 8:30 in the morning, and that's pretty much it. You do have Fed Waller later in the day, Fed Bullard later in the day around 1 p.m., and some energy data that comes out, some 8-week and 4-week bond auctions, but none of that is going to be as important as these other data points that we will be getting. Then coming on Friday at 8:30 in the morning, you have non-farm payrolls for June as well as the unemployment rate for June. That is part of the Fed's dual mandate. So surprisingly to some people, if the unemployment rate actually goes up, that could be seen as a very bullish thing for the markets because potentially the Fed won't raise rates as aggressively. I think we all know, though, the unemployment rate could tick up in a pretty big way, and it probably wouldn't change what the Fed is going to do. But what it will change is the Fed rate monitor tool. So this is essentially what the Fed will be following. We have a 93.3% chance of getting a 75 basis point rate hike at the next meeting for July 27th. Well, think back to what happened just a couple of weeks ago at the last Fed meeting, where on Thursday, we were pretty much sitting at a 3% chance of getting a 75 basis point rate hike. The CPI data came out on Friday that was really bad, scared markets, and then markets started to price in about a 97% chance of getting a 75 basis point rate hike. That next following Tuesday, well, what did the Fed do? They raised rates 75 basis points, and it was only like 2 days the markets were pricing in 75 basis points, and that's what the Fed ultimately went with. So if the markets start to only price in a 50 basis point rate hike, well, that's likely what the Fed will go with. If we start to price in more, God forbid, a 1% rate hike, well, that's probably what the Fed is going to do as well. They have not deviated from market expectations in the last like 40 or 50 years. So it's pretty rare that that would happen, and that would actually freak out the markets in a big way. That is why this data will be important, because it will change what the markets are expecting for interest rate policy. So that's what we have in store for this upcoming week. You definitely want to watch out for more crypto news, more potential bankruptcies. That is going to be very important for markets, and just even layoffs and stuff that we start to get announced is not going to be potentially a good thing, or it could be seen as a good thing. I think at this point, really for this upcoming week specifically, Tuesday is going to be a pretty chill day. Markets, they're going to be looking forward to Wednesday when you get all that economic data as well as the FOMC minutes, and then we could likely see a bigger move Wednesday, Thursday, and Friday. I think give or take a 5% rally for this week or a 5% drop will be on the table. A 5% rally from here would lead the S&P to about $400 per share. A 5% drop would put us back to pretty much 362, which would be the 2022 low. So I think it could go either way from here. We did get Tesla's delivery numbers and they missed by a couple thousand vehicles. I'm not sure that will be a bearish thing. It could be, but I think it might actually be a positive thing because they could have missed by a lot more. I think that's going to be the market's overall sentiment coming throughout the rest of 2022 as people do start to expect less for company earnings, so on and so forth. And that's one of the biggest things we have going against the markets right now, is that earnings expectations may be too high for the S&P 500. And like Michael Kramer here says, that has 1,031 articles on investing.com, says the equity market may be setting itself up for disappointment this summer. Earnings trends for the S&P 500 have been rising despite growing concerns of a U.S. recession due to the Fed tightening cycle. And I think it's pretty obvious when you have multiple companies like Snapchat coming out 1 month after giving their last guidance, giving their last company earnings, coming out and cutting guidance not even a month later by a big amount. Advertisers are slowing down. Things are slowing down due to what the Fed is doing. So you would imagine earnings would also slow down, potentially, get worse from here. And the fact that we are at all-time high expectations for margins when inflation is almost 9%, and you're at an all-time high expectation for earnings per share on the S&P 500 for 2022, like he says, it could be setting us up for some big disappointment. Good thing is we don't have any real earnings this week. On Wednesday you do have Levi's, and then on Friday I do believe you have WD-40, but those are not going to be important companies. Really starting over this next week is when you're going to start getting more important companies that could move the markets one direction or the other. You just seen Micron that came out that had really bad earnings that guided lower, yet that stock somehow did not fall through the floor. So we'll see what's actually priced in, what's not. Analysts have not brought down these expectations, so the data will be important from here on out more than anything else. And it says it right here that European markets closed higher on Monday as gas stocks lead. Uniper shares fall 27%. As U.S. markets are closed for the 4th of July public holiday on Monday, trading volumes were expected to be much thinner. And goes on to say that Europe did have a pretty substantial positive day. The European Stocks 600 index provisionally closed up by 0.6%, with oil and gas stocks jumping 4.1% to lead gains as most sectors and major bourses traded in positive territory. Tech stocks bucked the upward trend to fall 1%. So tech stocks on Monday in Europe did not do also well, but that is also coming the week before, or pretty much tomorrow. You're going to get the Bank of England. They published their annual or biannual financial stability report on Tuesday before the U.S. Federal Reserve releases the minutes from its latest Federal Open Market Committee meeting on Wednesday, and the European Central Bank publishes accounts of its latest monetary policy discussion on Thursday. So a lot of Fed speakers, a lot of data this week across the world pretty much, and that's probably going to weigh on different markets, and that is probably going to be weighing on equity markets in general. I wish I had a clear consensus on, do we get a 5% rally from here or do we get a 5% drop? It's pretty possible that we move around a lot, but we could stay relatively flat in between 370 and 380 in my personal opinion. If I were to put my neck out on a line and guess here, I think we're probably going to close the week roughly where we are right now, unless we get some really bad data that I cannot forecast for you guys right here and right now. So that is going to be it for this shorter 4th of July update video. Thank you guys for watching. Hit that like button and subscribe to the channel. Help push this video out to as many people as possible. Thank you guys for doing that. Enjoy the rest of your day, and I will see you in the next one.